Normally we could cover a lot of territory with a guest. I really can say, like, this is the first time, like, if we spent 2 minutes on every one of his businesses, we'd be an hour and a half in and we would barely get to dive in. So we're not going to be able to cover everything, obviously. The class is primarily about mindset, which I think I've been reading a lot of your writings in Inc. magazine, and I think that's really where we like to go. The students will ask questions about how you did it and the companies. And I'll hit some of that, but more about what it takes to be an entrepreneur, particularly a serial entrepreneur who's seen his share of battles and victories.
Sure.
In looking at your career, it seems that it's sort of defined by, sort of three things: solving big problems with technology, product focus, and cars. Yeah. What about those three things really make you tick?
Gosh, well, first of all, just being introduced to somebody who went to West Point and then went to Cal, it's probably more important to acknowledge I'm a multi-time college dropout. So I don't have a degree. I actually have been super impatient in my life, and most of what people would look at my career and say is that there's just a ton of failure. It's just so many tries that I've succeeded enough times to sort of make that part of what people look at and sort of remember. I think that great entrepreneurs, great companies, they are really about solving a particular problem. I've always been a problem solver, and it's funny, as an entrepreneur, you end up, as you have some of these successes, getting called visionary. And visionary, I think, is just really sort of, a way of identifying that you see something that nobody else really does. I don't really think of it as some lofty thing. For me, I've always had a particular view of what buying a car should be, and it really started with my sort of love affair with cars throughout my life. And cars have always been a way of marking where I'm at in life. And as I've gone into the military, I get out of high school, go into the military. One of the first things you do in the military as soon as you have any time off is you go buy a car. And that car sort of is a reflection of who you are in life. It's sort of your avatar. And so for me, my passion has always been related to automotive. So I've had about 50 incorporations at this point, and almost 24 of them have been focused on solving the exact same problem: buying and owning a car. And I've always believed that technology is really something that can provide a unique sort of way of doing that. And I believe that the way that we all get access to mobility is changing. So I've just had a fundamental belief that buying a car should be a joyful experience. If I look back at those sort of times in my life when I got a car, almost something good was always happening in my life. And as I sort of look back, at one point, we did a presentation on sort of the cars that I've had over the course of my life, and you can literally tell what I was going through and how well things were going based on the car that I had at the time. And I think that if you think about just in general, you get a new car when you graduate from school, you get a new job, you move to a new city, you start a family, you do something that is positive in life. Very, very rarely does a new car, whether it's a new or a used car, but a car that's new to you, sort of come along when something bad is happening. And yet at the same time, if businesses and entrepreneurs are about identifying a problem and then a solution, there is no bigger frustration in modern life than negotiating for, buying, and owning a car. And it turns out that almost 15% of everyone's gross income goes to paying for mobility. And when you start to unpack that, about half of that's going to the car, the other half is going to tax, title, and registration, insurance, maintenance, repair, fuel. So mobility and getting around is a big expense. If you make $100,000 a year, you're spending $15,000 a year on mobility, and about half of that's going to your car payment, and you're frustrated by it. So most of my companies have been focused on modern car buyers, leveraging technology. And if there's anything that's consistently clear about sort of a modern buyer, is that they don't like confrontation and they don't like commitment. So a lot of what we've done, not just at Fair, but almost every company that I've had, has been trying to figure out how to make buying and owning a car easier, less confrontational, lower and lower commitment, less costly, and making it just something that you find joy in. And I think that everything that I'm doing at Fair is the culmination of everything that I have perhaps failed at before. But it's clear that I'm doing something that I am passionate about. At this point, I have had a number of people that have come to me and said, as an entrepreneur, why aren't you going and doing different things? I am so focused on this thing that somehow I'm now 50. I'm now the old man in the space. I literally was the first entrepreneur to put an upfront price on a car on the internet. I was an Idea Lab CEO. All the things that we have done at this point are hard to replicate, and to the point where we have such a combined, and I say we, I've got a team now of 450 people, and many of these people have followed me from company to company. And so there is an almost institutional body of knowledge, and we are at this point the experts in the space, and that does change the dynamic in terms of what's possible.
There are advantages and headwinds in taking on entrenched industries and patterns of behavior. Obviously, I haven't shared this with you. I sold cars between undergrad and grad and law school for 4 months, and took it off my resume when I was interviewing at law firms because I didn't think it was prestigious enough. When every investment banker said that's the best experience you'll ever have. I went shopping this weekend with a girlfriend, and it hasn't changed. Not much, I mean, they're more likely to share the invoice because it's online, but the process is just so dispiriting. And when you get a good person, you can really tell. And I guess with an individual line like Tesla, that's taken your concept of sort of like streamlined, there's no negotiation, here it is. But to do it across brands, what are the key challenges of really digging in against an entrenched business? And maybe a lesson that you learned earlier with TrueCar with the dealer network then versus how you treat dealers now?
Well, if you think about, I was a college dropout, and I was starting an electronic database of used cars for sale in 1990-91 up in Northern California. And the internet wasn't a thing yet. Mosaic wasn't written until 92, and really the World Wide Web and the graphical user interface didn't come along until sort of 93, 94. And we were providing a relational database of cars that were for sale. We were aggregating all of the listings from AutoTrader and from the classifieds. We would take all the data, run it against known databases, expand all these listings so you could get a lot of information. You would call a 1-800 number. We would sell you the list and fax you the list. And so when I got started, there was none of the kinds of advantages you have technologically today. So if you think about what we're doing in the app for Fair, that just simply wasn't even possible when I got started. And so the odds of our success were very, very low. But I was that guy going into car dealerships trying to convince car dealers to allow me to list their cars with us as a service and pay us on a success fee every time we brought them a customer. And so my very beginning was almost as a car broker. And one of the things that I learned is that I was very good at buying cars and I hated selling cars. So at Cal, I became the car guy, and anybody who wanted to buy a car would come to me and say, hey, I hear you're the car guy. Here's what I want. And there's no selling involved. Because it was already a trusted referral, it was me taking an order, and then I would use that buying power, that order lineup, and I would go out and I would leverage that to get good deals on cars. And at Cal, we had 2 or 3 brands of car, Honda and Volkswagen, that really mattered to that audience. And I started buying 20, 30, 40, 50 cars a week. And all of a sudden, I was a fleet buyer, and I was getting cars at such a discount that if anybody knew anybody that was going to get a car, they would end up finding me, and I would end up delivering that car at a very, very good discount. At one time, as a student at Cal, I had as many as 20 or 25 cars parked around the block, waiting for delivery at any given time. So I just had a lot of hustle in the beginning, and I think that as I started to get into the business, there are so many great stories of how the existing incumbents did not want me to do what I was going to do. I was at the NADA, which is the National Automobile Dealers Association convention. I think this was in 1993 in San Francisco. And I had my first suit, and I'm standing out on the corner at a trade show trying to convince dealers to come to our program and to sign up. And I had this list or a group of dealers, and I'm sitting there telling them all about our service and what we're going to do. And I had these old school, incredibly fat dealers just heckling me from the hallway, telling me this is crazy. And then I barely get through my pitch. As soon as I turn off the microphone, the same hecklers came back and said, I'd like to sign up and lock up my territory. And I learned everything I needed to learn about the car business. They may not like you, but if you help them to sell cars and it's a good value proposition, they'll do it. And TrueCar was a lot of that. I mean, I was the guy publishing what everybody else was paying for their car. The actual sales data about what you pay for a car is publicly available information. We were the first company to simply say, we're going to go collect it. We're going to normalize the data, standardize the taxonomy of how a car is categorized, and then publish it. Car dealers felt like we were publishing the magician's handbook. And so I became literally one of the most hated guys in the car business because I was publishing what everybody else was paying. And what was fascinating is we could all go into the same car dealership on the same day and shop for the same car and talk to the same salesperson, and we would pay, some of us, almost 30% more than somebody else for the same exact car. And so my real issue initially was about new cars because I felt new cars were a commodity. And it seemed unfair to me that somebody should pay more than somebody else just because they didn't have perfect information. So by publishing that information, we took away the dealer's ability to work somebody who was either new to the process or a first-time car buyer. You could be a first-time car buyer and go to TrueCar. You could find out what everybody else paid. You could find out the invoice, find out what the MSRP was, go into the dealership, be completely informed, and just say, I am not paying more than $23,500 for the car. It didn't matter how good of a salesperson you were. You either met that price or you lost the customer. Once we did that, we saw prices narrow in markets like Los Angeles from 30% to 3% inside of 60 days. That's massive behavioral change. And so I really was the point of that attack. And it made my life actually quite hard. In fact, my journey as an entrepreneur is really about a lot of resistance and perseverance. I've got 4 children, and 2 of my kids, my oldest son and my oldest daughter, have ADD. And my oldest daughter is triple annoying to my youngest son. And he's like, Dad, Zoe is just the worst. I don't want her to be my sister anymore. And so as a father of 4, I just say, well, why don't we think about the things that makes all of us amazing? What do you think your youngest sister is amazing at? He says, oh, she's loving, she's kind. What do you think your older brother is amazing at? He's so smart and he's innovative. And he's, just willing to be really super creative. What are you really good at? I'm really organized. I'm a little bit OCD, but I'm really organized. What do you think Zoe's really good at? He said, she's really, really persistent. And I said, okay, well, why don't we ask all of you, what are the things that are going to make you successful in life? And everybody had a different answer, whether it was curiosity or whether it was IQ or whether it was a leg up. But we all ended up agreeing that persistence was the most important quality. And Noah comes out of that conversation saying, if persistence is what makes an entrepreneur or anybody successful in life, Zoe's going to be president of the United States. He went literally from, I hate my sister, to she's going to be president of the United States. And I think that if you think about the amount of setback and the amount of resistance, it really has, I think, been probably the narrative of my career as an entrepreneur, where if at any point I was disheartened by resistance, I wouldn't be standing here right now. If you really look into my background, I've lost everything 3 or 4 times. I've had to build up from the ground up. I ended up leaving TrueCar at the end of 2015. I took the company public in 2014. The stock was up to over a $2 billion valuation at $25 a share. I was the largest shareholder at the time, and I was also buying more stock in the public market than anybody. The stock, because car dealers were suing us, went down to $11 a share, and we missed our first quarter in 12 quarters in the second quarter of 2015, and the stock went to 6. And I got a margin call, which meant I had to retire from my own company in order to be able to make the margin call, or they would have sold my position into the teeth of the market, and I would have been wiped out. So I had to borrow money from a friend. I made my margin call, and I announced on that same day that I was retiring from the company that I founded, which is a really tough place to go. At the same time, I also filed for divorce, and then my house burned down. in the Skirball fire.
You're covering way too much. This is awesome.
Yeah.
You covered so much.
I literally lost my house, my marriage, the company that I founded. I, at that point, said, I'm going to go and start a brand new company focused on the exact same problem that I've been building for decades. And I started FAIR, and that was literally 3 years ago. And we'll talk a little bit, I think, about what FAIR has become today. But all of that was done in extreme adversity. I had to literally go back and figure out how I'm going to pay my bills. And I had to figure out how I'm going to pay my ex-wife, and I'm going to have to make sure that I take care of my kids. And so starting from scratch was really interesting. And it was a really fascinating thing for me because having founded almost 50 companies, one of the things I realized after leaving TrueCar was I wanted people around me that I liked a lot more. And my therapist thinks that the names of my companies have a lot to do with where I'm at personally. TrueCar, the ticker was true. I was looking for truth. I actually went to West Point because I wanted truth. My real father was not a very honest guy. And so for me, choosing to go to West Point was about trying to embrace integrity. And so when I decided to call FAIR, I was looking for fairness in my life in a lot of ways. And the first thing I decided I wanted to do was hire all women. I had read a book called The Athena Doctrine, and I figured I'm done with all these macho dudes in the auto business and the tech business and these hyper-growth, venture-backed startups that are just, do anything to make it work. The ends justifies the means. And the perverse incentive and the pressure that goes along with building a hyper-growth company in that kind of an environment is very, very male-dominated. And when I decided to leave TrueCar, it created a vacuum, and I just watched how disloyal all these mercenaries were. I had hired a bunch of killers. And I would have traded a little bit of gray matter for loyalty on that way out. So starting FAIR, I started with this initiative to just hire really great people. And the first person that I ended up hiring was a psychologist to make sure that my radar was right about who I was hiring. It turns out half the people that I wanted to hire, even for FAIR, she said, if you hire them, you'll end up having conflict. They won't support you, and they're just not a personality fit. They're just not good humans. And I came out of the military where I had a very sort of long sort of history of saying, I don't need to like my sniper. If my sniper is a good shot, I really don't care if he's an asshole. And so almost every time I strayed from her advice about who I should hire, I ended up hiring an asshole. And I'm still paying the price. I've got one or two of them still. But it is astonishing how toxic bad people are, even if they're mercenaries that are the best in the world at a particular thing. And so one of the things that we've learned at FAIR is that culture is by far the most important thing at the company because everybody ends up feeling a lot better. I like going to work now. And so it turns out my journey has just been about finding great people, not just about finding the best in the world at a particular thing.
And it sounds like, the differences in culture between the military and running a company like this are very different. And it may not have been your best skill, but it sounds like you're sort of refining that because as a CEO, that's one of the primary things you have to do is build a team. Let's dig into FAIR a little bit and then we'll talk mindset. So the problem that FAIR is trying to solve that must be solved now, and how are you doing it uniquely?
Well, so first of all, let me just give you a little bit of the problem set. You've got 1.5 billion used cars on planet Earth. They get sold about 10% a year. So about 150 million annual transactions occur for a used car. Most people cannot pay cash for a car. The average automobile costs about 1/3 of the average person's net worth. About 50% of their annual gross income is the cost of a car. So it turns out a car loan is how people get a car. And if you look across those 150 million annual transactions, you've got $5 trillion of consumer automotive debt on planet Earth. On average, it's at 10% interest. So the idea that we all have to go into soul-crushing debt to get access to mobility, and it doesn't matter if you're a mother working 2 jobs and you're barely on the sort of line of being able to afford everything, you still need mobility. And this idea that ride sharing is going to supplant car ownership isn't really turning out to be a true thing, because it turns out that while ride sharing is interesting, it's about $2 per seat mile for you as a passenger. Ownership is still 35 cents a mile. So
All in?
All in. So economically, ownership is less expensive. It's just more complex and it's more gnarly. I've been building these companies to figure out how to make buying a car easier because modern consumers don't want to go through the confrontation. You've probably all heard most people say, I'm not going to go into a car dealership anymore. That's a problem if you make and sell cars for a living. If your customers don't even want to go into a car dealership. But this idea of commitment isn't just that a car loan on average is 6 or 7 years. The idea of a car being so expensive relative to your net worth means you can't just walk away from it. You've got to figure out how to, if you're going to move to a new city, take a new job, go to school, you're going to have to get rid of that car. You can't just abandon it on the side of the road. So it turns out that you've got this massive debt problem and at a very high interest rate. And it turns out that almost half of what we spend on our average car payment is going to the interest. It's not really going to the car itself. And so in one really interesting way, the car business has pushed all of the risk of depreciation on cars as an asset to consumers. We all buy the cars, we drive them, they depreciate, and then we get very grumpy at the end when the car's not worth what we hoped it would be worth. Very rarely does a car appreciate in value. In fact, it's only about 2% of cars that even have a possibility of appreciation. Cars, by definition, are a depreciating asset, but they're a very durable asset. And so the problem is the experience is awful. It's very complex. You've got tax, title, registration. That the things that go along with owning a car, but you've got to do all these other things that cost just as much as the car. So if you're spending 15% of your gross income or $15,000 out of $100,000 on mobility, half of that's going to the car. The other half is going to tax, title, registration, insurance, maintenance, repair, fuel, and accessories. So if you're making $100,000 a year, you're driving about a $600 car payment and you're spending another $600 on other stuff. In the world of building companies, there's this magical sort of thing called a TAM, a total addressable market. And the size of your addressable market is really what sort of frames what you can raise money around. And so having a $5 trillion addressable market that has a $5 trillion set of natural adjacencies that go with that addressable market is a really compelling opportunity. Nobody has ever really gone after combining all of those things. Nobody would really think of going into a car dealership and buying your insurance from a car dealer. You wouldn't give them that much power in the negotiation. But what we've done at Fair is we've bundled everything into a single monthly payment, single cost of ownership that includes all of those things. So part of what we have built starts with really understanding the consumer and working backwards. It was everything that we identified was a problem about buying and owning a car, the confrontation, the commitment, the going into debt. And so everything that we've created as a solution is about attacking that problem set. And what we learned is that the only way to deliver that outcome is to actually own the car ourselves. And so our business works in a very interesting way. You see all these cars that are in the app. These are all cars that are currently for sale in the market by a local dealer. And just to give you a sense of how big that market is, you've got 90,000 auto dealers in this country. There are more car dealers than McDonald's, Starbucks, Dunkin' Donuts, and Burger King combined. You've got 60,000 independent used car dealers that sell used cars, and you've got 32,000 franchised new car dealers that sell used cars. So 43 million used cars a year get sold just in the US alone. At any given time, if you go to one of about 6 different sites like Car Gurus or Auto Trader, TrueCar, Cars.com, you can find about 5 million cars for sale in the US. And the companies that I have built have had a lot to do with standardizing that data. But today, through those APIs, without physically inspecting any of those cars, we can suck up all of those advertisements. By law, every used car that's advertised must carry a VIN number. We look at those VINs. We can now unpack everything about that car. We can run that car through about a half a dozen known databases in a way that you as an individual consumer never could. We know which of the 5 million cars are being advertised for sale, for example, at a very good discount or a very good deal. We also know for the first time the empirical value of a car at wholesale and at retail to within 1 or 2%. So if you give us a VIN and a license plate on a car, we can give you a price on that car that is going to be so accurate that we'll actually buy that car sight unseen. We'll buy that car without the need for a physical inspection. So what's possible today because of the data is just part of the solution, but this idea that we could go out and buy the car requires that we raise a lot more money. So in my career, I've raised, prior to FAIR, about $2 billion of equity for my companies. So I have been widely sort of thought of as a fundraiser, and a lot of the things that I do when I go to business schools or the Inc. magazine stories are about fundraising. Entrepreneurs want to know how am I going to raise money, and just being a well-known fundraiser in Los Angeles, having raised a lot of money, I get a lot of entrepreneurs coming and asking for that advice. FAIR has been a little bit different. We've been around for 3 years. So I incorporated FAIR literally the week I retired from TrueCar. And that was right at the end of 2015. And I started recruiting my team. And the process of building a company and getting momentum starts with a big idea. And then the founder is really about going out and recruiting that core team. I started recruiting automotive experts and engineers that could help make what I was doing a reality. That was all 2016. We did not have a product or anything that anybody could really look at until 2017. I raised our first round of money just from friends and fellow entrepreneurs. It was all done as convertible debt. It was a very low-key process, but we ended up raising about $17 million over the course of that 2016 year, which gave us the ability to get up and running. We launched our app in August of 2017. By the end of 2017, we made our first acquisition. We bought Uber's exchange leasing business. We ended up having to borrow a lot of money to do that, but we ended up buying 40,000 cars in one transaction, and we ended up having 20,000 active Uber drivers. So today we own about 7.5 or 8% of all Ubers in the US, and we are Uber's exclusive partner for flexible ownership. We now have 30,000 plus active subscribers on the platform, but since August of 2017, we have been growing almost 40% quarter over quarter. So we started advertising in June of 2018, television, radio, digital, and as we started to do that, we started to build an installed base. We now have over 3 million installed app users. What's remarkable about the app today that's very different than all the other companies that I had built prior is that it's not about leaving breadcrumbs. It's not about everybody going on to the website and telling us what they're looking at. In the app, when you download the app, we get your phone number, and the amount of information you can get from that today is truly staggering. We know your social, we know your income, we know if you're a felon, we know if you've ever had a DUI.
I signed on yesterday.
So
It's interesting.
we know a ridiculous amount. And this is not a hard credit pull. We're not taking your PII. What we're doing is we're asking questions of the data. And what we're trying to do is qualify you, because the first and most important thing that we are is we're not lending you money. We're a payments platform. We want to make sure that you're not a thief trying to steal our car. And if you've got a felony arrest record, we don't want to give you a car. If you've had a DUI, it turns out we're going to put you behind the wheel of a real car, and we're going to insure you. We do not want to put people on the road who are not insurable. A big part of our business model is we underwrite all of our own insurance. We self-insure it. We reinsure it for risk. We use a third-party administrator that white labels the entire experience. So we're capturing all of those natural adjacencies, but what's happening at the beginning of the app is completely seamless to you as a user.
Can you walk them through the experience? So hit Explore Cars. I want them to see how it works, and then you can say how. I actually leased a car in December, and I'm sort of mad because I think I would have liked to do and just search Tesla. So it's any car you want. And by the way, which do you think are more profitable to sell or lease? New cars or used cars? Which? Used by far. New is highly subsidized by the manufacturers. That's why everyone got mad at him for sort of disclosing the prices. People make more money on used cars because no one knows what you acquired it for. I don't know if you know what people acquired it for. So these are used cars on lots. If you were to lease a new Tesla S, Their payment with sort of a minimum drive-off is about $1,200–1,300. Now these are 3-year-old cars, right? I just turned in a 2015. So this is no commitment, right? So you can rent it by the month for that.
So one of the things that we really recognized is that we needed to give you an opportunity to have a car without having to sign a long-term commitment. And it turns out our 3 customer groups are Uber drivers, millennials, and early adopters. So early adopters tend to be looking for a more expensive car, like a Tesla, and they tend to have credit, better payment history, and they have a different set of priorities around what matters. And then millennials are looking for great transportation. They may not have as good a credit score, but because we're not lending you money, what we're looking for in the app when you give us your information is, are you going to steal our car? That is a very different conversation than what a bank is thinking about. A bank is thinking about, are you going to make 72 monthly payments in a row? People who have little credit history or no credit history don't really come up as a good bet for 72 of anything in a row. And so what we had to do is convince the sources of capital that even though we don't have a contract term, that the average human, when they get into a car that they like, stays in it for a certain amount of time. So even though our contract lets you turn in the car whenever you want, the average consumer is staying in the car for 18 months. They're just staying in the car because they're happy. And it turns out that even if you can walk away, if you're in a car that you like, it's a hustle to go and say, I'm going to get a different car. Now, there's probably a very real value proposition for the early adopter crowd where they can get 4 or 5 different cars a year, because one of the cool features about this is you don't have to pay tax up front when you get a car from us. When you buy a car, you got to pay 8% on the cap cost or the selling price of the car. If you're doing 2 or 3 cars that are $50,000 a year, all of a sudden you're spending $20,000 or $30,000 on tax. Because what we do is charge you on a monthly basis. When we buy the car, we operate with a dealer license as well. So you find a car in the app, that car is for sale at another dealer. You say, I want the car. We've already found that car to put in the app based on the dealer advertising that car for sale. We run it through our math. We bundle every car with roadside assistance, a warranty, and a standard maintenance plan. And we now offer month-to-month auto insurance as well as excess wear and tear like you would get at a rental car counter. But it prevents you from having to go and put this on your own insurance policy. It turns out for almost everybody, our insurance is half the cost of what their personal insurance would cost. And that's partly because we have a corporate umbrella policy, and this is truly a situation where you get a group buying discount. We are basically insuring everybody and then passing on that savings in the form of a lower monthly payment. But the hassle goes away. You're not being taxed or titled or registered to that car. You are basically just being entered into a usage agreement, and what we need from you, other than a valid driver's license, is a digital form of payment. So think of credit like going to a restaurant. You eat your meal, and effectively the restaurant is giving you credit. You pay at the end of your meal. In this example, this is much more like a vending machine. You've got to pay us for the first month, and you got to pay us a start fee to get the car. And if you want to stay in the car, you got to keep paying. But if, for whatever reason, your employment changes, you fall in love, you got to move to another city, you graduate, you go somewhere else, it's time to turn in that car. All you have to do is just say you're done with the car. You don't have to turn into a used car salesman. You don't have to figure out how to pay off a loan. You just walk away from that car, and then we handle it. What that means is we have to be able to price depreciation very accurately. So almost everything we're doing is built on this very big data exercise around being able to price depreciation accurately. So we take all of that risk. When you choose that car, we simultaneously enter into an agreement with you to use the car, and we buy the car from the dealer. We pay the dealer instantaneously. When you go to either pick up the car or the dealer delivers it to your home, in the moment you take delivery, it's like signing the car from a valet. You take the car, we take your payment, we pay the dealer. So we are out for the $20,000 that the car costs, and you are now paying us on a monthly basis for the usage of that car.
And what happens after 2 months that someone changes? They've paid you $500 over 2 months. You've just put out that money. what do you do with the car again? So you're the largest buyer of used cars in the country now, aren't you?
So it turns out with 42 plus million cars being sold in the US on the used car side every single year, there is no liquidity crisis for used cars. So when that car comes back, we actually put it into a 30-day pool. And that 30-day pool means we put it back on the app and we look for another customer. And if we find another customer for that car, they get the car. And that's an ideal scenario for us because we already own it. But alternatively, it doesn't matter if you keep the car for 60 days or 6 months or 6 years. We've been pricing that depreciation and we're very unemotional and we just simply sell that car because we've calculated our exit on a daily basis based on a slope decay of 50 years of the US vehicle fleet and how it depreciates. So we're not going to be right on every car, but it turns out that cars depreciate very predictably. When cars are brand new, the second they become a used car, they lose 15 to 30% of their value. That is the most severe moment. That's why none of our cars are brand new cars. And it turns out right now, we're going through a cycle change in terms of supply and demand. You've got 6 million vehicles being returned from lease in the next year to 18 months. 6 million cars coming back into a market where we only make 15 million new cars a year is a very, very huge inflation of supply. And what that does is it brings prices on used cars down. So what we're finding is that we're buying cars very attractively as the prices fall. And it turns out if there's a recession, what happens in a recession is credit tightens. That first affects the new car business. And when customers can't get a new car loan or a new car lease, they fly to value and they buy a used car. If you look at sales volume over the last 100 years, it almost perfectly correlates to population growth. It doesn't matter recession or not, total vehicle sales, new and used, are totally linear and highly correlated to population. The cycles in the car business have to do with recessions. In times of recession, new car sales dip. In 2009, new car sales went from 16 million down to 9 million, and it created a very predictable coming shortage of late model used cars. The used car business for the last 3 to 5 years has been one of the hottest businesses, period, because there was a short supply of used cars. We've now been at peak production for the last 3 to 5 years, so we're now entering a period where we have a glut of used cars. So it's just a very interesting economic analysis of when to get in and when to get out. But almost everything that we wanted to do for our customers is possible because we own the car. We get to rewrite all the rules. In a traditional car purchase or lease, the amount of paperwork you have to sign and the sale of a car and the financing of a car is one of the most highly regulated categories, bar none. And because of how we do this, we don't have to publish the selling price, the interest rate, there is no term. So it's a very simple contract between us and our drivers.
Yeah, more like a rental agreement than anything, but still, it's a paper-driven business that you've taken down to mobile device, sign with your finger, and then go take the car. I want to open up the questions in a minute, but you covered so much, and I want to talk about a couple of lessons that you've learned. One, I love the article that if you get a chance, he writes for Inc. magazine. There's 4 lessons he learned by watching his house burn, which is really interesting of what you sort of count in life. But the other article I read, you talked about with your family that you sort of inventoried the traits that you would like to see in an entrepreneur. I think you guys came up with a list of like integrity, intelligence, curiosity, passion, optimism, and resilience. Those traits or requirements were missing something that you were seeing more and more of from successful entrepreneurs and in yourself. Can you share the other frequent trait you were noticing and how you reflected on that and how you came to address it in your life?
So I don't remember in that particular article. Is there something?
You're talking about sort of life as an entrepreneur. We've got all these super successful entrepreneurs that come in here, and you've shared the ups and the downs. But a lot of people romanticize entrepreneurship and what it takes to be an entrepreneur. And there's a flip side and there's a dark side to it. And so I wanted you to sort of really share that reflection.
Well, I wrote an article right around the time that Kate Spade and Anthony Bourdain committed suicide. And the number of entrepreneurs that I know that are depressives, very high. I mean, being an entrepreneur is a very, very high pressure situation because the way I look at borrowing money, and I literally think of it that way. I've raised a lot of money, but I don't know, you guys are all too young for this, but there was a movie after called Startup.com. It was one of the most annoying movies I'd ever seen because it was about these kids who had come out of business school, and then they were doing it at a time when there was so much enthusiasm for starting anything with a .com that they could raise money, and they were horrible entrepreneurs, and they gave entrepreneurs a really bad name. But this idea that, you know, you're an entrepreneur and you've got to take on stress. When I take money as equity, I think of it as a loan. And that's really the way I think about it. And everybody who lends you money as an entrepreneur wants 10 times their money. I don't care what anybody says. It's not about an IRR of this or that. They want 10 times their money. Doesn't mean they all expect they're going to get it, but that's why people pick up the phone. And entrepreneurs aren't really taught that when you're selling an investment, what really motivates an investor to give you the money is fear, not greed. Almost nobody gives you money because they want to get richer. The people who invest in companies are already doing well. They invest because they're afraid of missing out. It's FOMO. And you got to make it clear that if they don't write you the check, they're going to miss out. So that saying, you know, the train is leaving the station, getting somebody's money, nobody ever wakes up and says, oh, I forgot to wire Scott the money. It's because we call them and say, we're closing on Friday. If you don't wire, you're out. We're taking somebody else's money. It's okay. And it's that trade-off between not needing it and letting them know that you've got alternatives, but you've got to introduce fear in order to actually be successful at fundraising. This fear, though, means that you have to be astonishingly good at one really cool trait, compartmentalization. This ability to compartmentalize stress and deal with different, like when I was going through my house burning down, health problems on my own, walking away from TrueCar, just massive debt, divorce. Those kinds of things are only manageable by just saying, I cannot solve everything at once. I'm going to have to put these issues aside and focus on the problem. And having been in the military, understanding what triage is all about, you know, understanding how to solve the most important problem and then just move on sequentially to the next has been, I think, a very important lesson. And as I've gotten to know lots of very, very big thinking, high risk entrepreneurs, you do have to take big bets. You do have to bank on your vision. You have to defend yourself, but you're making company bets all the time. And the only way you get through that is by a combination of compartmentalization and this outrageous optimism. The number of times where if I actually took an inventory, an audit of where I'm at, it would be so depressing and it would not be inspiring to anybody. If people could actually sort of walk that line with me as an entrepreneur. And some of the best entrepreneurs out there, and a lot of these people I know, are right on the edge of this Jekyll and Hyde of unbridled enthusiasm and optimism for what they're building and a belief in what they're doing, and total devastation. Everything is a binary all or nothing bet. And I think the notion of really trying to pay attention to the mental health of entrepreneurs is fascinating. Not everybody is an entrepreneur. And in fact, when I used to speak at business schools, one of the first things that I would get asked, you know, what makes a great entrepreneur? And I would do this sort of test and I would say, okay, is everybody in the room trying to be an entrepreneur? Who's got a side hustle? Who's starting something? Everybody would stand up. I said, okay, who's more than $10,000 in debt as a student trying to build their own company? And stay standing and everybody else sit down. And then you get a group of like this and you'd see maybe, 15, 20% of the room standing and you say, okay, 20,000 in debt. You just keep going until you have one person left. And you say, that's your entrepreneur. The amount of debt that I went into while I was a college dropout at Cal, I had about $400,000 of cold, hard, train riding cash debt that I carried into my first sale of a business. And then because I had borrowed that money and I had to repay everybody, I let people take the option of getting repaid or rolling into my next venture. I've always been very, very focused on my reputation and making sure that everybody, even the dealers who hated me, made money with me. One of my biggest detractors is a guy named Bert Bachman who owns Galpin Ford.
Sure.
I mean, Bert is a legend in the car business, one of the biggest dinosaurs in the car business, and he's also a big investor in Fair because he wants to keep an eye on me. But he was one of my biggest detractors at TrueCar. He is on the board of the New Car Dealer Association in California. They sued us. He wanted to see me done, out of business. He made about $4 million on TrueCar by putting a $250,000 investment in at the very, very beginning. So he made money, and then when I retired from TrueCar and came back and said, I'm going to do Fair, he said, I'll invest, and he invested about $2 million back into Fair. So he's one of my seed investors here, my biggest detractors. So, I've cared very much about sort of my reputation, but I don't know how healthy our really, really impressive entrepreneurs are in general. I'd say about half of the really amazing entrepreneurs I know, if you catch them on the wrong day, are total depressives or completely detached optimists that you're just like, how can everything be so good? Everything's falling down around you. It is sort of a wall-to-wall existence, and it is not something that everybody is cracked up for. If you aren't generally optimistic in the face of really bad news, if you're not able to compartmentalize, it's definitely not for you. The ability to carry debt, handle setbacks, and be persistent is by far, of all the things that my kids and I went through and identified all these great skills and qualities and traits, it wasn't curiosity or IQ, it was persistence and just being able to come back, and that has a lot to do with the mental health. And I was really touched by what happened with Kate Spade and Anthony Bourdain. I just thought that was a tragic outcome, and we just don't talk about it enough in entrepreneurship.
Yeah, and we're actually starting to research around that, both with high-performing athletes and entrepreneurs who are sort of like high-performing athletes in a lot of ways. So whether it tracks or exceeds sort of the population at large, I think is something to be interesting. Everyone always asks me, and I've been interviewing people and had people here for 15 years, and there is one quality that is absolutely sort of common, and that would be optimism. If you've taken Paul Orfila's class, Paul's the founder of Kinko's who teaches here, and he said, what does he say? No one wants to follow a leader who's tired, haggard, or miserable. You have to, you have to have that idea that we're going to get through this. We're going to be okay. There's a realistic part of that as well. But if you're not an optimist, it's probably you're probably not set to be the CEO. There are other roles. You can be a 2, 3, or 4 in a venture, but maybe not the CEO. I want to give you guys time to ask questions of Scott. He's going to give a master class on auto, my favorite business, by the way.
Hi, my name's Nate. Thank you so much for coming. I have 2 questions. One is, if you get a car on Fair, are you allowed to put snow chains and snow tires on it?
Yeah.
And my other question is, how do you see the onset of autonomous driving affecting the insurance industry? And do you think we're going to eventually not pay for insurance like we do today?
Yeah. It's interesting. That's a great question because I get asked all the time about how autonomous driving is going to eliminate car ownership. And the physics of having 1.5 billion cars on planet Earth that are non-autonomous cars means that the physics of car ownership are going to be decades before we even have to worry about that, because it's not even a real thing that we're making all autonomous cars yet. I mean, about 1% of cars have level 2 autonomy at this point. So we make 80 million new cars on planet Earth every year. So it's going to take at least a decade before we get to level 5 or level 6 autonomy, which is a self-driving car, being 100% of the cars that are manufactured. But even at that pace, given that we make 80 million and there's 1.5 billion carrying $5 trillion of consumer debt, those cars are going to be bought and sold for decades. So autonomous technology is not going to eliminate car ownership. And so far, it has only been additive. I mean, ride sharing was supposed to be another thing that was going to eliminate car ownership. And it turns out we've had our biggest car selling years in human history over the last 5 years. So during the rise of ride sharing, we're just buying more and more cars. And in fact, what's fascinating about ride sharing is it was started on this idea that it wouldn't have to make the capital expenditure to own the cars like a taxi fleet used to. You would have the drivers own the cars. And so the impact of autonomy, I do think you're going to get to a place where if the Uber pulls up and there's a human being driving the car, you're probably not going to get in the car. It's not going to be safe. You're going to think, I'd rather have the car drive me to where I'm going. I think what's about to happen with insurance is amazing, though. Insurance is going to be sideswiped because what's going to happen is level 1 autonomy, level 2 autonomy, and level 3 autonomy are going to mean that all of a sudden you can parallel park your car without dinging the other car. You can not run people over because the car brakes for itself. It won't change lanes when you're going to cut off and pull into a blind turn. You're not going to come up on another car too fast. I mean, cars are just going to get safer and safer, and very few people are going to have accidents, and that's just going to have a direct impact on insurance. The fascinating thing about insurance is we all either overpay or underpay for insurance. The only way to know if you're the one getting a good deal is to wreck your car. So everybody's paying an average for the people who don't wreck their car and the people who do wreck their car. So it turns out that insurance, by definition, is a law of averages thing, and it's a progression to the mean, and it doesn't really have any desire to be efficient as long as it's affordable. So what happens with usage-based insurance and insurance based on better driver behavior, it brings down the cost. It is a complete disruption to auto insurance. And it is probably 5 years before the insurance companies that are currently winning today either have to reinvent themselves or be in a different business altogether. But that business will be a shrinking business. Cars simply won't kill nearly as many people as they do today, and they won't have nearly as many accidents and won't need nearly as many repairs.
Sounds good.
Hello, sir. Thank you for stopping by, first of all.
Sure. Wow.
I was wondering if you could talk more about your military background
Yeah.
and the lessons you learned there that still help you today.
So I joined the Army at 17. My dad was an ath, and I wanted to get out of the house. And so for me, joining the Army was freedom. And I actually grew up in a family where I thought going to West Point would be a cool thing. I was set to go to San Diego State University, and I was down there for a summer program, and I had a motorcycle, and my motorcycle threw a chain by the Mission Bay Aquatic Center, and it was right by an Army recruiting office. And a guy named Dwayne Stafford came out and started talking to me as I was trying to fix my bike, and he showed me the West Point brochure. And he says, if you take this test, we'll see if you qualify to go to whatever language school you want or whatever, kind of military post you want, and try to get into West Point on your own. And the idea of joining the Army, enlisted to go to West Point, is literally something only a kid with ADD would do. I had ADD for sure. And so I thought, this is brilliant. I don't have to get good grades. I don't have to finish high school well. I can just join the Army, excel in the Army, and go to West Point. And my grandfather was the ambassador to New Zealand under Bush 41. And so I thought, this is the coolest thing of all time. I'm going to be able to go to West Point without using any family help, and I'm going to go ahead and do it on my own. So I enlisted in the Army when I was supposed to be going to San Diego State the next semester. I came home and I told my parents I've joined the Army, and they were like, you got to be kidding me. I got to Fort Leonard Wood, Missouri. I was in military intelligence. I went through basic training. I very quickly became my squad leader, then my platoon leader, and I was the only one who could really read the Common Skills Manual. Half of the other soldiers that were coming in were avoiding prison time or otherwise just not really folks that were competitive with the way I was thinking about the military. And so I started thinking about West Point. I ended up getting into a Spanish language training program. I became fluent in Spanish. I went to the Defense Language Institute in Monterey, and I was trained where the military and all the defense contractors get trained for different military assignments around the world. So I was trained, and I very quickly realized I'm with a group of people that are following me from training to training. I didn't realize it at the time, but we were being trained for the invasion of Panama. And so he aprendido español a la escuela militar, hasta un entregador de español, un paracaidista también en 1987 para la invasión de Panama. So I was a Spanish interrogator, and Nobody thought I could rap in Spanish. And all of a sudden, I'm at the 82nd Airborne. I went through airborne, air assault, survival, escape, evasion, scuba school. I got all of these badges, and then all of a sudden, I took the test and I got into West Point. And I had to go to what they call the Military Academy Preparatory School, where you go and you work on your SATs. About 10% of new cadets are out of the military. So I got to the prep school. I had 2 rows of ribbons. I had all these badges. I did not go to the invasion of Panama. The 16 people that I was trained with all went to the invasion. And then I went to West Point, and I went through the prep school, got into West Point. When I showed up, I was a little bit older than all the other cadets that were coming right out of high school. I immediately got nominated to be class president. I was there for 2 years. I was class president. I played rugby, and then I got a rugby scholarship to come to Cal Berkeley. And it turns out after 2 years at West Point, you're allowed to get out of the military. So I was in the military for about 4 or 5 years total, got out, came to Cal and played rugby at Cal, started a company when I was at Cal. So for me, the military was freedom. I remember when I came home from air assault and airborne and scuba school, my dad, who I did not get along, was very proud. All the women in the family were very upset. Everybody got happy when I ended up going to West Point. And it turns out that for many, many years, my brother and I didn't get along because he went to Cal Poly. And I came home and I'm wearing cadet grays and I've got all these ribbons and everything. And he's like, what a jerk. And so it had a really interesting dynamic in terms of my family. But for me personally, before I went to the military, I didn't have any independence. I didn't have a job. I didn't have any of those skills. And so for me, it was a really important formative thing. I now have 4 kids. Kids tell you what they're going to be very early on. They all have very different personalities. And I can just tell you that I have a little girl who's going to be a princess in fashion of some kind, and she is just all about her dolls. I've got a tomboy. She has got ADD, and she has no interest in going to school or staying in any kind of a structured program. She'll be a great entrepreneur. I've got a son who had ADD, who about 4 years ago hated the medication that we had him on, read online that if he stopped eating sugar and started working out twice a day, that he could maybe not have to take his ADD medication. He went from 130 pounds to almost now 200 pounds. He's 16, he's 6'4". I ended up marrying my squad leader, who was my squad leader at West Point. She ended up graduating from West Point, and she became a captain in the Army. And so we were married for 16 years, but our oldest son, Luke, now wants to go to the Naval Academy. And he and I were talking the other day. He's all about, the military, and he wants to be a SEAL team commander. He's done all of his work. He's got severe ADD, but he's non-medicated now, and he's this big athlete. He plays water polo, and he's, an amazing kid. And we were talking about his grades, and he's doing very good in school. And he says, and it doesn't matter if I don't get in. If I don't, I'm just going to join the Navy anyways. And then I'll go to Annapolis through the Navy. I'm like, this is a horrible idea. He's like, why? You did it. I mean, it's just really fascinating how these things sort of repeat themselves. But for me, the military was my version of going to college. And when I ended up coming out to Cal, I was already a junior when I got to Cal. I didn't have anywhere near the same experience because literally when I first got to Cal, I started my first company. So I've been sort of serious about business for a long time. And being in the military is a lot different than being in college. We didn't have frat parties. We just went to bars. And so for me, the military was all about freedom.
Thank you.
Cool. Coming around.
Hi, thank you so much for coming. This doesn't have anything to do with entrepreneurship, but I'm curious anyway. What's your favorite car overall, and what's your favorite car that you've owned to date?
The favorite car that I've owned to date was a 1999 Ferrari 550 Maranello. It was my first new car. Amazing car. I still like how it looked from a design point of view. It turns out I ended up buying that car, and Michael Dell was one of our earliest investors at carsdirect.com. And at one point he said, I'm going to introduce you to the CEO of Ferrari. We went to the Ferrari USA headquarters in New Jersey. And this guy's name was John Luigi Buttoni. And Buttoni says to Michael Dell, Michael, would you like to buy a car? And Michael's, what, $20 billion? Like, sure. And he's like, which one would you want? And Michael picks a Spider that was like, probably a $120,000 car. And Bottoni says, we'll put you to the front of the line. And Michael says, only one request. I want to have a webcam while they're making the car. He says, of course, no problem. And then he turns to me and he says, Scott, would you like to buy a car? And at the time, I had no money. And I said, of course, I'd like a 550 Maranello GTB. And I ordered this $250,000 car. He's like, amazing car. And I had the Daytona leather, the 2B exhaust. I was so detailed in my order. Even Michael was like, so. I was like, and I want the webcam. And so that was my first car. That was a big, big deal to take delivery of that car. And I drove that car for 5 years, and I put 35,000 miles on a Ferrari. And it was at this weird moment where, after Cars Direct, there was a lot of people trying to get this particular car, and I got called by Symbolic Motors, and they offered to buy the car for more than I paid for it new. And I had beaten the crap out of this car. And I said, I'll take it. And they came and they took my car away, and I made the money on the car. And I was like, wow, that's, I'm going to buy that car back one day. And that has been a car that I will probably go back and sort of, go back and get at some point. When my house burned down, I lost all of my cars, and that was sort of a hard spot. I had just bought a car that wasn't yet on my property, and today it's sort of my prize car. It's a 1966 Mustang 350 GTB, and it's a really interesting car because it was the original Hertz rent-to-racer car. It was, at the time, the fastest production car in the world, and Hertz was buying these cars special from Shelby. They bought 100 a year, and you could rent this car and take it down to Pomona, and you could race it on the weekends, and it was called a weekend rent-to-racer. And Roger Penske was one of the investors in CarsDirect.com and has become a friend over the years, and Roger has tried to buy this particular car for years and years and years, and it was interesting because at one point Penske and Hertz were part of the same organization back in the day. So this was a car that Roger put on the road as a rental car. And after the whole TrueCar thing, I end up saying I'm going to retire, and I get a phone call from an 85-year-old dealer in Indiana who says, congratulations on TrueCar. I've got a couple of sons, and they're bozos. They don't realize that this particular car that I have in the garage is such a special car. But when I heard what you're doing with Fair, which is basically a rental, a temporary, car program that gives you the ability to get access to a car that you might otherwise not have the ability to get. He's like, I thought it was perfect. I'd sell it to you. And he gave me a price, and I said, I'll take it. And so he shipped the car out to me. And it was like one of the coolest moments because his sons didn't value this car at all. And the car was perfect. I mean, absolutely, like as if it was brand new. And the only person who envies that car at this point is Roger Penske. He's like, I've been trying to buy that car, and he knew the car dealer, and the car dealer had said, I'll never sell it to Roger Penske. I'd rather sell it to you. So that's probably my favorite car. But that's an appreciating asset. That's not a depreciating asset. So it's not a car that would be good for Fair. That's a car you should actually go buy.
I feel so off asking about this after hearing that story, but well, I've watched that advertisement that you've put up in for your intro maybe 20 to 30 times in the last
Yeah.
week. What's your exact advertising strategy? Because it's weird that yeah.
So if you think about building any business, one of the moats in our business is our brand. One of the things you don't think you're going to get treated like when you're going to buy a car is fairly. And so this idea of naming the company Fair, when we named the company TrueCar, it was about providing truth into an experience where nobody expected truth. And it was truth in data, which leveled the playing field and made somebody an expert without having to be an expert, right? Fair was about delivering an outcome that people recognized inherently as fair. And so one of the things, there used to be a saying early on at Google that said, don't be evil. I remember the first time I heard that, I'm thinking, who has to actually remind themselves not to be evil? And I remember I was just learning about Google, and I was thinking they must be very powerful if they have to say that to themselves. But as we started building Fair, I ended up bringing in all of these automotive experts. And it turns out the one thing that automotive experts don't do is prioritize the customer. They just don't. It's not their default setting. They think about how cool cars are and they think about doing cool stuff, but they always want to make money. We've got 450 people now. We call them the Germans and the geeks, and the Germans are all people that came out of the car business. I have a partner who was the CEO of Mercedes Credit Corporation and BMW Financial Services. So everybody on the German side of the business is this customer last, really smart auto finance expert. And the geeks are a bunch of people that really focus on the magical technology. These are people that have worked for me and all of my companies in the past. Most of them are not car people, but they're really not focused on how do we make money at this. They're just focused on how do we make the experience wonderful. It turns out there's something that came up in our process as a company. We ask ourselves in everything that we do, is it fair? And it turns out that even my youngest kids know what's fair and they know what's not fair. I mean, fairness is actually a really interesting concept. And if you think about what our moat is, it's about being associated with fairness in a world or in a market that is least associated with fairness. And so all of these businesses come down to a math problem. Customer acquisition cost is the most important variable to get control of in growing a new business. So for us, we are trying to get installed users and we're trying to establish a brand. Part of that comes from the lore of raising a lot of money. So to date, we have raised about $500 million of equity, and we've raised a couple of $2 billion of debt. I just came from meetings today with about 20 bankers from Japan, from SoftBank, who are trying to figure out how to get us $4.5 billion of debt right now for the next 12 to 18 months. So the scale at which we're operating right now is sort of staggering. The reason they're investing, the reason that they like what we're doing is because when we have 3 million installed users, we did something very interesting about 2 months ago. We stopped advertising just to see what would happen. So now what we've created is a body of users who are going through their process of getting out of the car they're in, selling their car, ending a lease, and thinking about what's next. And we can see when people are playing with the app and what they're looking at and what they're doing and what they're hovering over. And so we've got an incredibly engaged frequency with 3 million in-market car shoppers in a way that nobody has actually really had before. Because we've almost gamified the experience of shopping for and looking for a car. It's so low friction and non-intimidating that people tend to stay in the app for quite a bit and they play with it and they like their favorite cars. And so we're building a massive body of data, but it's all around that brand equity. And it turns out that when I was first starting to recruit for talent, I mean, the team that I've assembled is literally one of the best in the world at what they do. Almost every single one of them, when I said we owned Fair.com, I said, how is that possible? And when I decided to start the company, we had no investors and no money, and I went out and I paid $2 million for a domain name. And that's one of the reasons why my ex-wife and I are now divorced. She thought that was a very, very bad idea. And I said, I don't think you understand what I'm going to go build with it and what the value is of having a one-word domain name that means what we're going to go do. And so it turns out when you buy a domain name, you don't buy any rights to anything. But what you do get is this notion of eminent domain. So we started trademarking. We now own the trademark to the word fair. That is astonishing. We have now extended this brand equity into other countries. Almost everybody in the automotive industry now knows who we are. We're rolling between 200 and 300 cars a day. Average car, $15,000 to $20,000. That's $5 million worth of cars every day that we buy to then now generate revenue. We're already operating at about $500 million in revenue run rate. So the business is compounding. We'll be at 500 cars a day within 60 to 90 days. That is, at that pace, over 100,000 cars a year. It makes us the largest automotive retailer on the planet in under 2 years of having a product in the marketplace. So it's a pretty staggering hypergrowth story. I would argue that it's not possible without a brand like that. And it's funny, when I was building TrueCar, we met a car dealer in New York who tried to sell us one of his car dealerships. And at the end of the negotiation, he said, you know what, if we don't get this deal done, I'm going to go into competition with you. And I said, really? He's like, and he was dead serious. He says, I've reserved the domain name icarumba.com. And Ernie Garcia, who founded Carvana, is one of the earliest investors in Fair, and he's a good friend. When he told me, I had the same laugh. I thought Carvana was the worst name possible. And it doesn't mean that you can't succeed with a bad name, but Car Gurus and Carvana, I don't think those are great intuitive brands. I think you can build enough behind them and they can work, but I think it's a big challenge. It's much better. I have always loved very elegant, simple names. Cars Direct, TrueCar. I had Dental Advantage. I was one of the guys behind 800 Dentists. I mean, for me, brand has always been where I begin, and then design. The first people that I hired for Fair were the Apple design team at Media Arts Lab that only has one customer, Apple. And all they've been doing is designing two-dimensional graphic arts, beautiful stuff. The reason why everything you see in our app looks beautiful, it's all been designed by people who design for Apple, not for apps and not for usability. So it all looks very pretty. The way that we actually initially started the company was the designers went through a theoretical exercise of how beautiful it could look, and then we gave the engineers the designs and said, just make it live. Make it real. It's a very different sort of product development process as well. But
All right.
to me, I think brand is everything.
Let's take a real look.
After my son Luke got a car from Fair, he turned 16, he gets a job, he gets his driver's license, he gets a bank account opened up, he gets his car from Fair, and he literally says to me, Dad, I don't get it. Before Fair, how did kids get cars? This idea that somebody who's just turning 16 is going to be able to go out and get a bank loan for $10,000 or $15,000 to go into debt to buy a car is just ridiculous. So if we're right, nobody's going to have to go into debt to get access to mobility. You're going to get all the benefits of car ownership. If you think the real benefits of car ownership, it's status. That's my car. Optionality, you get to go where you want, when you want. You get the security of locking your stuff in the car, child seats, whatever the case is. So you get all of that with a car from Fair. The only things you should actually be borrowing money or investing your own money is if it's going to be a fetish item or an appreciating asset. If you really love it and you got to have it, go buy it. But that's going to be a smaller and smaller percentage of the overall car business.
I'm so grateful that you're doing this, because it really, for this generation who doesn't need to own as much stuff, it is one of those things that's broken. It's been broken for so long, and it takes somebody to see the problem and just say, it's going to be really hard to change behavior, but we're going to do it, and you're going to need a lot of money to do it. So I'm behind you. I actually said to my girlfriend this weekend, I'm like, I'm sort of pissed that I have this 3-year lease that's got 34 months left.
Yeah.
Because I get bored after about 16, 18 months. I want another car anyway. So I think it's a great solution, and I really appreciate sort of the master's class on the auto business. Let's thank our guest, Scott Painter.
Thanks for having me.